So we've got some interesting stuff to dig into today, right? You sent over some really thought-provoking material on venture capital and how these investments are analyzed.
Yeah, for sure.
It seems like the core question here is, are we missing some future giants because of the way VC firms are looking at companies?
Yeah.
And if so, is there a way to improve how we spot those potential successes?
Exactly. I mean, we're really trying to get to the bottom of why so many VCs seem to be missing these huge opportunities.
Right. And a good place to start is this observation from Harry Stebbings on Twitter. He
Mhm.
was talking about how a bunch of major European startups were just completely overlooked by all these VC firms.
Yeah, totally.
And it really gets you thinking about like the whole process behind these investment decisions,
Yeah, absolutely.
Like what are they looking at? What are they missing? And thankfully there's some good research on this. This study, Machine Learning about Venture Capital Choices, goes way beyond just anecdotes.
Right.
It uses this massive data set of like over 120,000 French companies founded between 1998 and 2010, and it's all linked with tax data. So the researchers were able to use machine learning to really dig into what actually predicts whether a company gets VC investment, and even more importantly, where those VCs are potentially making errors,
Uh-huh.
both in terms of backing companies that end up failing and missing out on those that become super successful.
Yeah.
So it's not just about those European startups that Harry Stebbings was talking about. This study is giving us some real data to suggest why this might be happening on a much bigger scale.
And I think what's really interesting here is that the study looked at over 100 different characteristics of founders and their companies, all information that was available at the time the investment decision was made.
Okay.
They wanted to know, okay, so which of these factors, if any, are statistically linked to a successful exit?
I see.
Does having a founder who went to an Ivy League school really mean they're more likely to succeed?
Right.
Or is it just a perception?
Exactly. And what did they find? What really stood out in those correlations?
Well, some of the findings were pretty striking. Even after controlling for all those other factors, they found that male founders were 1.4 times more likely to receive funding.
Hmm.
Graduates of elite schools were 3 times more likely.
Wow.
And founders based in Paris were twice as likely. And this was even when the data showed those factors didn't actually predict success.
Oh, wow.
So it really does make you wonder if there are things beyond just pure business potential driving those decisions.
Yeah, I mean, those disparities based on gender and where someone went to school, it's pretty stark. I'm curious, did the researchers delve into why these factors seem to carry so much weight for VCs, even if they're not actually predicting success?
Well, when we connect this back to the bigger picture, it seems like there are some biases at play in the whole investment process.
Mm-hmm.
The study even uses the term over-indexing on subjective founder attributes and calls it a lazy pattern matching bias.
Okay, what does that mean exactly? Break that down for me.
So imagine, always betting on a tall basketball player just because historically tall players have done well. But you completely ignore this shorter player who's got incredible agility and shooting accuracy just because they don't fit that traditional mold.
Oh, I see.
You're so focused on that one attribute, height, that you miss other important qualities. It's the same idea here.
Yeah.
Investors might be subconsciously favoring founders who fit a familiar picture.
Yeah.
Maybe they went to the same school, they worked at the same company.
Right.
But they're overlooking truly innovative ideas from people who don't fit that mold.
So what you're saying is it's almost like they're limiting themselves by relying on these patterns, right?
Exactly. And it goes back to this idea from Daniel Kahneman. What you see is all there is. It's like this pattern matching bias where you latch on to these easily observable traits thinking they're a sure thing.
Like a prestigious university on a resume.
Right, exactly.
Okay.
But you don't even bother to look for the data that might tell a different story.
So how do we get around this? How do we address these blind spots?
Well, the study highlights 2 main approaches.
Okay.
First, we need to be aware of this data and what it's telling us.
Yeah.
Recognize that these biases, even if they feel intuitive or valid, can lead to some big missed opportunities.
Right. So awareness is step 1.
Exactly. Step 2 is to actually rethink and redesign the entire investment process.
Okay.
So that means reconsidering how you evaluate information during a pitch. Maybe you don't even look at the resume until after you've heard the idea.
Interesting.
And it means taking a hard look at your internal priorities. Are you truly valuing innovation, or are you just going for the familiar?
So it's not just about recognizing the bias, but actually changing the way you do things to counteract it.
Exactly. The goal is to reduce that over-reliance on pattern matching because, as the study points out, the most groundbreaking success often comes from people who don't fit the mold.
They're the outliers, the ones who are doing things differently.
Right. They're the ones who are challenging the status quo.
And if you're just looking for the same old patterns, you're going to miss them.
Exactly.
So the study basically frames managing these biases as just as important as traditional risk management, right?
Absolutely. And it argues that both of these things, bias management and risk management, should be fundamental parts of how we train VCs.
Yeah, I think that's a really important point. So let's quickly recap the key takeaways here. We've got data-backed evidence that biases are at play in VC investment decisions. And this could be leading to some serious missed opportunities. There's an overemphasis on certain founder characteristics, even when those characteristics don't actually correlate with success. And that's because of this pattern matching bias.
Yeah.
So the way forward is twofold. Increase awareness of these biases and make deliberate changes to the investment process to minimize their impact.
Exactly.
And this brings us to a final thought for you, our listeners. How might this tendency for pattern matching, which seems really efficient in a lot of areas, actually limit our ability to spot truly novel ideas and unconventional paths to success? And I'm not just talking about venture capital here. This applies to so many fields.
Yeah, that's a good point.
It makes you think about how we can balance that need to recognize familiar patterns with staying open to those game-changing outliers.
Absolutely.
So that's something to ponder as you go about your day. Are you missing out on something amazing because you're too focused on the way things have always been done?
It's a good question for all of us to ask ourselves.
Thanks for joining us today for this deep dive.
My pleasure.